Do you think the Federal Reserve is trying to slow down the stock market? And if they do that, like, what would happen?
Yeah. So there's been several articles on this and different speakers at conferences talking about the fact that they feel like the Federal Reserve is sort of purposely targeting. It's a little controversial as to whether they are or not. But I will say you could see why they might want to. And the reason is, and I've seen this many places, the two big drivers of consumer behavior are house price increases and stock market increases. And so when those are both up and going up and up and up, people want to spend more. And of course, the Federal Reserve is trying to slow down demand until supply can catch up, so we can get, this inflation, especially core inflation and this PCE inflation, back down to that 2 to 3% range that they're looking at. That one stat that keeps running through my head is that household wealth in the U.S. from the bottom of the market in March of 2020 to the end of last year grew $36 trillion, right? And so, hey, there's no question as to why we have all of this spending going on when there's that kind of growth. And so the Federal Reserve, of course, is going to raise rates, which can make the market kind of rocky all by itself. But what's been more suspicious is how drastically they have changed their verbiage and how aggressive they've been with their verbiage. They used to be much more careful about what they said and how they said, because I don't know, I watch the minute by minute charts, and when the Federal Reserve Chairman Powell is speaking, or one of the other chairmen of the Federal Reserve board members, you can see the impact. I mean, the market cares dramatically about what the Federal Reserve has to say. And so they've been saying things that have been really hammering the market. And I think it's also a little bit suspicious that a lot of times when we've had big run-ups, all of a sudden we have an interview with somebody who starts again talking aggressively. So they might be putting a cap on the market. My hope is that because we have seen today, right, the core PCE, personal consumption expenditure price index, dropped. The overall PCE price index dropped, right? Those are the two areas that the Federal Reserve looks at the most. They're really trying to slow down job openings. We haven't seen that yet, but maybe that starts. I'm hoping that some of these things that they're trying to accomplish have peaked out and we're on the right trend, and maybe they can back up a little bit on some of their rhetoric, right? And keep on. The market's okay with the path we're on. It's just this situation of, oh, hey, we're going to have 2 half-point rate increases, and then they come out and say, nope, we're going to actually do 0.75 or 1%, or and then the market's going to adjust down. So if they really want to bring down the market, that's exactly what they'd come out and do. Next week, the week after, one of the Fed governors would come out and say, we're still looking at 0.75. And so, and the market has to respond to that, usually by readjusting to the downside. So anyway, I don't know if that's true or not, or if they're really going after it, but it makes some sense that they would, right? Because they need to bring down personal spending, at least to a certain degree. The danger is, of course, they bring all this stuff down too much, kick us into recession, and then you've got a whole different stock market issue, that's happening. And then that's the fear that the market's dealing with right now.
So what do you think about how spending actually went up while the price went down? So does the Fed be okay with spending going up while prices are coming down? Are they
That's
happy
a
with
perfect scenario for the Fed. They would love that, right? I mean, what that means is that most likely, I was thinking about that today because it's a great point. Spending is up. It was up higher than expected. And then the core PE, not even counting food and energy, which are really, a wild card right now, but core PE dropped and dropped more than expected, year over year especially. And so what happens there is that we've got this scenario. How did it drop if spending's still high? Because essentially that means demand is still there, because there's only 2 reasons I can think of. Number one is supply is picking up and is still coming in and slowly but surely. Even with China's problems, supply is better this April than last April. I could see that, right? I can see that. We've heard lots of good things about the ports and trucking and different things that are getting better and those type of things as far as that goes. The other thing is that you might have companies that aren't raising their prices as much, And we certainly saw that with like Target and Walmart when they came out with their earnings reports over the last couple of weeks. They missed their earnings, and really what happens is their costs went up, and they didn't make their prices at their stores or website go up. And so there is some compression of earnings in that scenario for some companies. And so those two things are maybe slowing it down, even though spending is still there, at least in my opinion. That's a perfect situation for the Fed as far as I'm concerned. Compression of earnings could be an issue long term, right? I don't think the Fed wants to see that happen drastically, because that's a recessionary signal, at some point in time. And the market responded quite negatively to that, especially the Target miss, right, last week. So Target's had a nice little bounce coming back as a good company. Maybe it oversold, but nonetheless, I think that's a good thing. And the market is responding today. At least, we're live right now, so I don't know where the market is. But, the market has responded, just before the show started, was up quite a bit. It was, like I say, it was a green shirt day, which is fantastic.